So now we can proceed. We do more illustration on published financial statement. So open with me November 2015, question 1. November 2015, question 1. November 2015, question 1. So hope you are there. And you're told that Donna Limited, a quoted company dealing in household goods, has prepared the following trial balance as at that 1st of December 2014. So their financial year ends on that 1st of December. So that means the financial year starts on 1st of January 2014. So we have the revenue, loan interest paid, we have the purchases, we have distribution costs, admin expenses, interim dividend paid, inventory as at 1st of January 2014. Now that's the opening inventory. Then we have trade receivable and trade payables, cash and cash equivalents, ordinary shares, share premium, general reserves, retained earnings as at 1st of January 2014, 4% loan payable 2024, land and building, where the cost of the land is 60 million, accumulated depreciation, plant and equipment, investment property as at 1st of January 2014, rental income, and then we have proceed from sale of equipment. Additional information, number 1. Closing inventory as at that 1st of December 2014, now that's at the end, amounted to 388 million at cost. However, shortly after the year end, so that means after the year has ended, that's on that 1st December 2014, after that, however, shortly after the year end, some inventory with a cost of 15 million was sold for 8 million. Now that's what we call the subsequent events, the adjusting events. We say that in case there is any sale of inventory before after the year end, they are called adjustment. So how much was that? So number 1, there was loss on stock. Now let's read the second sentence. The second sentence, we are told that. However, shortly after the year end, some inventory with a cost of 15 million was sold for 8 million. So it was worth 15 million, but we only realized 8. So that means there was a loss of 7. How do you account for this loss on stock? Now, loss on stock, you add it to the part of the cost of sale, then you reduce from the closing stock. So you debit or add to the cost of sales, then you credit or you minus the closing stock. As simple as that. So that means how much is our adjusted closing stock? Adjusted closing stock. Now, to adjusted closing stock, we have been told that number 1, closing inventory as at that 1st December 2014 amounted to 388. So it's 388. You minus the loss on stock 7. So that means the adjusted closing stock will be an amount of 381. And then we say that whenever you are given the closing stock and additional information, that means we are not given the cost of sale. Therefore, how do we determine the cost of sale? Cost of sale, it's opening stock plus purchases minus the closing stock. Now let's go to the trial balance. How much was the opening stock? To the trial balance, the inventory as at 1st of January 2014 was 444. You want the purchases, the third item in the trial balance, 1669 minus. So it will be easier for you to work with the adjusted closing stock, 381. Or alternatively, you can also work with 388, but once you get to the closing stock, you add the loss of 7. Or alternatively, just work with the adjusted closing stock, 381. If you work with this 381, the adjusted one, remember I said that this 7 you added to the cost of sale. You will not add because now you have already adjusted the closing stock. Or you could have also worked with the original cost, 388 as your closing stock. Then once you get the cost of sale, then you add this loss on stock. And with that, how much will be your cost of sale? Yeah, the cost of sale will be an amount of 17. That too. It will be an amount of 17. That too. Good. That's number one. Let's go to note number two. Number two. Land and building were revalued on 1st of January 2014. Now, when is 1st January? 1st January is at the beginning of the year. It's very important for you to determine when we did the revaluation, so that you determine whether to charge depreciation for the year or not. So, number two, there was a revaluation of assets. And you told that land and building were revalued. So, we have land and building. We see that the motive is to determine whether we revalued at a gain or a loss. And how to determine the revaluation gain or revaluation loss? We see that you compare, number one, the net book value or the carrying amount against the revalued amount. So how do we get the net book value? Land does not depreciate. So let's go to the trial balance. Land and building at cost, where land is 60 million. Land is 60. So therefore, how much is the building? It's 380 minus 60. So that means the cost of the building is 320. But note that building is a depreciable asset. So you minus the depreciation. So below it, we have accumulated depreciation, an amount of 64. An amount of 64. So how much is the net book value? So the net book value will be an amount of 256. Now, those are the net book value or the carrying amount. Then you compare that against now the revalued amount. So let's go to still at note number two. Land and building were revalued on 1st of January 2014 to 800 million, including rand 100. So rand is 100. So if we revalue to 800, of which land is 100, so that means the building will be 700. So that means we revalued at a gain. There was a revaluation gain. A revaluation gain of 40. Here you have a revaluation gain of 444. 444. So how much is the total gain? It will be 484. And you see that revaluation changes for PPE and available for sale should be recognized under other comprehensive income. Then we have already revalued, but we ordered at the beginning of the year. Therefore, building is a depreciable item. So we need to charge depreciation charge for the year. So we determine the depreciation. Now you'll take the revalued amount of the building, which is 700, because it was revalued at the beginning of the year. You divide by the expected remaining economic life. We go back to note number 2, the last sentence. The building had a remaining useful life of 40 years. So you divide by 40. So how much will be depreciation? That's what we call straight line. Eh? Depreciation per annum will be an amount of 17.5. Will be 17.5. And we say that, have they stated whether to take the depreciation? They have not. Now, in case they are silent, but it's okay. First of all, you have to read everything. But in case they are silent, use your judgment. In case it's building is used for admin purposes. So that expense should go to admin expenses. In case they don't specify, use your own judgment. Number 3, income tax liability. So whenever you see anything to do with the tax, what comes to your mind should be the tax expense. And we see that tax expense is made up of 2 elements. One is the current tax and the changes in deferred tax. And we have been told that the income tax liability for the year was estimated at 20 million. So the current tax is 20. Then after that, deferred tax was to be provided at 7 million. So if you go to the 12 balance, can you go to the 12 balance? Do we have any deferred tax? Do we have any deferred tax? So there is no deferred tax. So that means the deferred tax was 0. Then they have decided to provide it at 7. So there was an increment by 7. So they'll pay tax expense of 27. So previously they had not made a provision for deferred tax, but this year they decided to make a provision of 7. So this 7 is an increase, so you add it there. Also this 7, the balance carried down, you'll take it to the balance sheet as part of non-current liability, as part of the deferred tax. With the balance sheet, you take the balance carried down. Number 4. During the year, the company sold some equipment which had cost 15 million and accumulated depreciation as at 1st January 2014 was 3 million. So up to that point, there was disposal of equipment. So how much was the net book value at the date of disposal? If you dispose an asset, you want to determine whether there was a disposal gain or a disposal loss. And how do you get that? So you compare between the disposal proceed against the net book value of the carrying amount. And you're told that during the year, the company sold some equipment which had cost 15, that was the cost, with an accumulated depreciation as at 1st January 2014 of 3. So that means at the date of disposal, the net book value was 12. An item of plant, so up to that, how much is the disposal proceed? Now let's go to the trial balance. The last item in the trial balance. Disposal proceed. Yeah, there was proceed from the sale of equipment. So that means we sold it at 7. So, was it a gain or loss? Now, in the trial balance, the last item we have is proceed from the sale of equipment, of which we fetched 7. But the net book value was 12. So did we dispose at a gain or loss? That is a loss on disposal. There was a loss of 5 because the net book value was 12. That's the carrying amount. But you only fetched from the market 7 million. So that means there was a loss on disposal, an amount of 5. And see at number 4, the second point. An item of plant was also estimated to be impaired by 4 million during the year. So there was also impairment of plant. And asset was considered impaired by 4. Impairment and depreciation, they are almost the same, but they are not the same. And then you are told that, so we are through with that. Number 5, depreciation rate as per the company policy is as follows. Building over the useful life period, of which we have done for the building. So number 5, it's all about depreciation of asset. For the building, we have already computed. It's over the useful life. Then plant and equipment, 20% reducing balance. Then we are told that the company accounting policy is to charge full year depreciation in the year of asset purchase and none in the year of disposal. The company treats depreciation of plant and equipment as cost of sale and land and building as admin. So therefore you're told that depreciation of land and building, you will take it to the admin, but for the plant and equipment should be treated as cost of sale. So, and how much the rate? We're told that plant and equipment is 20%. So you take 20% reducing balance. And remember, you have been told that, note this, the company policy is to charge full year depreciation in the year of asset acquisition and none in the year of disposal. So let's go to the trial balance. We go to the trial balance. Plant and equipment, the cost was 258. We minus the accumulated depreciation, and the accumulated depreciation is 126. Now reason here. We are using reducing balance, but the asset we disposed, we don't provide the depreciation on the year of disposal. So I've taken 258, which is the cost, minus depreciation of 126, so that we get the net book value. Once you get the net book value, you eliminate the net book value of the asset that was disposed. Because we have disposed, so we don't provide depreciation for the disposed asset. You take the cost minus depreciation to get the net book value. But that net book value also includes the net book value of the asset that was disposed. So here you also deduct the net book value of the asset that was disposed, and the net book value was 12. And how much with the depreciation? So here we have an amount of 24. And this 24, we take it to the cost of sale. Remember I told that depreciation of land and building to admin expenses, but for the plant and equipment to cost of sale. Good. And now we go to the other point, number 6. Number 6, we are told that Dora Limited values investment property at fair value. Yeah. And the assets and liability investment property is under IAS 40. What is investment property? So that investment property, they are assets held to earn rentals or for capital acquisition. And they are always measured at fair value. So we have investment property. That's under IAS 40. Now let's go to the trial balance. We go to the trial balance. We go to the trial balance. The third last item, we have investment property as at 1st January 2014, the value was 548. It was 548. So now let's go back to note number 6. Number 6, we are told that Dora Limited values investment property at fair value. The fair value of investment property as at that 1st December 2014 was 586. 586. Was there a fair value gain or a fair value loss? So there was a fair value gain, an amount of that 8. Now the question is, where do we recognize? Is it under other income or other comprehensive income? Is it other income or other comprehensive income? If I take you back to the first page of your notes under NBs, we see that revaluation changes for items measured at fair value, their revaluation changes should be recognized under other income. So this one will go to other income. But for PPE and available for sale and intangible assets will go to other comprehensive incomes. Good. Last note, number 7. Number 7, you're told that during the year, the company made a 1-for-3 bonus issue capitalizing its general reserve. This transaction has not been accounted. So there was bonus issue of shares. And you are told that during the year, the company made a bonus, a 1-for-3 bonus issue. 1-for-3. What does it mean? That for every 3 shares, you get 1 bonus share. That means you don't pay for that share, you get it for free. Now let's go to the trial balance. In our trial balance, how many shares did we have? So we have ordinary share capital, each at 10, of which the share capital is 100. So to get the number of shares, you'll take 100, you divide by the par value, which is 10, to get the number of shares, which is 10. And what was the term? For every 3 shares, you get 1 bonus share. What about 10 million? They'll get how many bonus shares? And you get 3.3 shares. 3.3 million shares. Then you convert them into monetary terms. The par value is 10. So that means the company issued bonus shares worth 33 million. I repeat again. The terms was for every 3 shares, you get 1. So how many shares does the company have? So the share capital is 100, but those are shillings. But the par value is 10. So you take 100, you divide by 10 to get the number of shares. If for every 3 shares, you get 1 bonus, what about 10 million? You get, the company issued how many bonus shares? And they issued 3.3 shares. Then each share, the par value is 10. So the company issued shares worth 33. But this was bonus, so the company did not receive any cash. So ordinary share capital will increase. So you add ordinary share capital. But where this amount we never issued cash, so the company never received cash. So what happened? They transferred this amount from the general reserve. That's what we're told. Can you go back to note number 7? During the year, the company made a 1-for-3 bonus issue capitalizing its general reserve. So this amount was fetched from the general reserve. So from general reserve, you minus 33. So in short, that's what you call the transfer. That's why the company have reserves. So that means whenever the company gives free shares to the shareholders, they transfer that amount from other reserve, they transfer to the ordinary share capital. And that's what they did. Good. And we are through with all the adjustments. We are through with all the adjustments. Number required. Let's go to the required. Prepare in a format suitable for publication the following financial statement for Dora Limited for the year ended that 1st December 2014. One is the income statement, statement of changes in equity, statement of financial position. Note to the financial statement are not required. Round your figure to the nearest medium. So now before we present that, we say that PPE is recognized as a single element. Also expenses are classified into 4. So now let's do that one as a working. We can first of all deal with the expenses. So expenses, we have number 1, cost of sales, admin expenses, distribution expenses, and finance cost. Cost of sale, this was the opening balance. We have the cost of sale, an amount of 1732. How much was the admin? The opening balance for admin, let's go to the top balance. The opening balance for the admin expenses is 345. What about distribution? Distribution is 514. What about the finance cost? Now, finance cost carries the interest. Now, note this. In our trial balance, the second item, we have loan interest paid. How much did we pay? It's 3. Now, we have a 4% loan. Now, let's go where you have the 4% loan. Now, whenever you are given any debt or preference share, and you are given the specific rate, for example, this one is a 4% loan. So if you want to determine the finance cost of the interest, you'll take 4% of 150. And 4% of 150 is 6. Now, this is what you call the interest charge for the year, and that's what you're supposed to take it to the income statement. What they incurred rather than what they paid. But if you go in the trial balance, the second item, their own interest paid, they have shown you 3. So that means that 3 in the trial balance is what they have paid. But what they incurred was 6. So this 6, you'll take it to the income statement as the interest expense. But to the balance sheet, there is an accrued loan interest. They are supposed to pay 6, but the trial balance, they have shown that they have already paid 3. Good. So 6, you take it to the income statement, then the other balance of 3, you take it to the balance sheet. So those are the opening balance for the expenses. Then you add, it's only 2 items which were affected. Here, there was depreciation on building, of which we are told that you classify them under admin expenses, 17.5. Also, there was depreciation of plant and equipment, cost of sale, an amount of 24. Plus, now, since any expenses relating to plant and equipment, you are taking to the cost of sale. Also there was loss on disposal of 5. Also that one you take it to the cost of sale, because all expenses relating to plant and equipment, we are taking to the cost of sale. Also, there was an impairment of asset 4. You also take it to the cost of sale. Loss on disposal is a cost, is an expense. Also, there was impairment loss, an amount of 4. So how much is that? So for the cost of sale, it will be 1765. For the admin expenses, will be an amount of 362. So distribution, there was no adjustment. Finance cost, there is no adjustment. What else can we work? Also PPE. We have not yet presented for PPE. Let's work here for PPE. Remember also we said that PP is recognized as a single element. Now for PP, we have land. In land, you take the revalued amount, here it is. Land was revalued to 100, so you take 100. Also, you have buildings. Buildings was revalued to 700, so you take the revalued amount 700, but you deduct the depreciation charge for the year 17.5. So you minus 17.5. So that one will be 700 minus 17.5, get an amount of 682.5. Also, there was plant and equipment. Now let's be here. For the plant and equipment, you'll take 258, that's the cost. You raise depreciation 126, you get the net book value. You raise the net book value of the asset that was disposed. Then you raise depreciation charge for the year. So it's 258, that's the cost. You raise the accumulated depreciation, which was 126, minus the net book value of the disposed item, which is 12. So that you get now the net book value at the beginning. Then during the year, they charge a depreciation of 24. So you minus 24, minus, we are told that an item of plant was considered impaired by 4. Impairment is more like depreciation for the year. So you also deduct the impairment loss. So how much is that? That one will get an amount of 92. You will get 92. Or alternatively, for you to understand PP, you can do this. I want you to understand PP. Plant and equipment, I mean plant and equipment, the cost, you can take 258. You raise accumulated depreciation of 126. And how much is that? 258 minus 126, it's 132. That's the net book value. Then, of the asset that we disposed, the cost was 15, but there was accumulated depreciation of 3. So how much was the net book value? The net book value was 12. So you minus, because we disposed that asset, and you get an amount of 120. Then you raise depreciation for the year, of which we had provided depreciation an amount of 24, and then there was impairment loss, an amount of 4, and you still get 92. So any can do. So therefore, how much will be the value of PP? So PP will be an amount of 874.5. 874.5. Good. So now we can present. So, and remember you said that working carries no marks. Working carries no marks. So what we have been doing here, you have 0 marks. Now presentation is what is now more. Dora Limited. Income statement for the year ended on 31st of December 2014. We start with the FRIMA, that's the sales or the revenue. Let's go to the income, to the trial balance. In the trial balance, how much is our revenue? Our revenue is 2648. Then you deduct the cost of sales. Let's be here. Here is the cost of sales. The adjusted cost of sales is 1765. And that's how you get your gross profit. How much is your gross profit? It will be 883. Once we have that, you add other incomes. Now, under other income, number one, we have rental income. How much is the rental income from the trial balance? How much is the rental income? So rental income, we have an amount of 48. Then there was fair value gain. Yeah, remember there was a revaluation of investment property. Here it is, investment property. There was a gain of 38. You take it to other income, an amount of 38. Then we deduct the expenses. Other operating expenses, we have administrative expenses, selling and distribution expenses, and then we have finance cost. So our admin expenses, the adjusted one is 362. Then there was distribution expenses, an amount of 514. Then finance cost, an amount of 6. And that's how we get our profit before tax. So how much would be a profit before tax? Profit before tax would be 86.5. That's the profit before tax. Then we can deduct our tax expense. Here it is. The tax expense, we had the current tax and the deferred tax, so the total is 27. So you deduct 27, and that's how you get the profit after tax. And the profit after tax, an amount of 59.5. Then you can add other comprehensive income. Now, under other comprehensive income, there was a revaluation gain on land and building. So revaluation gain, an amount of 484. Here it is. 484, you take it to other comprehensive income. And that's how now we get our total comprehensive incomes. That's how we get our total comprehensive income, an amount of 543.5. Good. That's part A of the question. Now we can also present part B. Part B, we have to present the statement of changes in equity. So you have dollar limited. Now, to the statement of changes in equity. Now, what do we have which goes to the equity? So, based on the information provided, number one, we have ordinary share capital. I can also see we had share premium. We also have the retained earnings. Also, we have general reserves. And also there was revaluation reserves. That's what we have. Those are the elements of equity we have. So we start by recognizing the opening balance. That's the balance brought down. Balance brought down. Now let's go to the total balance. Ordinary share capital, we have it's 100. Share premium, we have 244. Retained profits, we have 349. General reserves, we have 570. For revaluation reserve, we didn't have any balance at the beginning. So I've just recorded the opening balances for each component. Then, during the year, there was a bonus issue of share. And for the issue of share, The company issued shares worth that to shareholders, capitalizing its general reserve. So you see that this amount will be transferred from the general reserves to ordinary share capital. So ordinary share capital increased by that 3, but that amount was transferred from the general reserve. So from general reserve, you deduct that 3. That's what we call the inter-reserves transfers. So we have just transferred that. Then you also factor in the profit after tax. Profit after tax, we say that will affect the retained earnings. And the profit after tax for the year was 59.5. Then there was also revaluation gain. Now note that for the revaluation gain, what you take to the statement of changes in equity is only what is in other comprehensive income. We don't factor in fair value gain. You see fair value gain, it's part of other income, which is already included in profit after tax. So to the statement of changes in equity, you only take what you have, the net you have under other comprehensive income, an amount of 484. Then there was payment of dividends. There was dividend paid. And remember, you said that we pay dividend from the retained earnings. So let's go to the trial balance. Trial balance, how much was the dividend paid? And we paid dividend worth 6 million. And that's how we get our balance carried down. So here we have it's 133, 244 for 2.5, 537, 484. So now lastly, we can present the statement of financial position. Now we present the statement of financial position. So to the statement of financial position, so let me wrap this. So we start by recognizing the assets. And for the assets, we have the non-current assets and the current assets. So to the non-current assets, number one, we have PPE. PPE, here we have the amount. For PPE, we have 874.5. Then there was investment property. Now for the investment property, you take the revalued amount, and that's courtesy of note number 6. The revalued amount is 586. Yeah, you take the revalued amount. Then we have the current assets. So to the current assets, number one, we have inventory. Now for the inventory, you work with the adjusted inventory. Note number one, we had 388, but then there was loss on inventory an amount of 7. So you take 381. So it's 388 the cost, minus a loss of 7, the loss of inventory. So you take an amount of 381. Then you also add cash and cash equivalent. For the cash and cash equivalents, we have an amount of 28. Also, I can see we have receivables. How much is receivables? We have 545. Then we go to the other part where you have the equity and liabilities. To the equity and liabilities. Now, to the equity, we have already presented the statement of changes in equity. So you take the balance carried down. So we have ordinary share capital. We also have the share premium. We also have retained profit. We also have general reserves. And then we have the revaluation reserve. So ordinary share capital we have is 133. We have 244. We have 42.5. We have 537. Then we have 484. Then we have the non-current liabilities. And non-current liability, we have 4% loan notes. We have 4% loan note, an amount of 150. Then there was deferred tax. Note number 2. Note number 2, I told that. Number 3. The income tax liability for the year was estimated at 20. Now that 20 is the current tax or the current liability. Then we are told that deferred tax was to be provided at 7 million. So there was deferred tax, an amount of 7. Then lastly, we have the current liabilities. For the current liabilities, we have the current tax. And current tax we are told was 20. Then if we have trade receivable, we must be having the trade payables. And trade payables, it's an amount of 434. Then we have the interest payable. In our finance cost, you see it was 4% of 150, which is 6. But the second, I think the third item, the second item in the trial balance was loan interest paid. We had already paid 3. So it's 6, the expense. Then you deduct what you have already paid, and the balance will be 3. So 2414.5. And that's how it balances. As simple as that. So you can look at that for 30 seconds, but you already have this one working in your solution, in your notes. Then I want us also is we can try another one illustration. So you need to take out your handout. So I want us to try another illustration. December 2009 question 2. Now that question might not be in your past paper. Now just look at your handout. Handout between page 6, 7, 8. I've arranged those questions topically. The one for published financial statement. Just check that. I'm not sure about the page, but it's there. And I published the one for December 2009 question 2. It's in your handout. Handout between page 6, 7, 8, 9 there. Because I have arranged those questions topically. The one under published, the revision questions. I have arranged the revision questions there. Hope you have found the question. It's only one question and published, the one I have provided in the handout. So that's the question we are doing. And we are told that, hoping we are there, the following balance has been extracted from the book of Z Limited as at that 1st of October 2009. We have PPE, accumulated depreciation as at 1st of November 2008. Investment property, that's land. Inventory as at 1st of November 2008. Purchases, we have sales, admin expenses, distribution expense, interest paid on debenture, 10% debenture. Remember, you have said that whenever you're given a debt and you're given the rate, the interest rate. So always, for determining the interest expense, work with the rate. Now, for example, in this case, we have 10% debenture. So therefore, the interest on debenture you see it's 10% debenture. So it's 10%. You take the value of the debenture, which is 2,000. Therefore, the interest should be 200. Now, this is what you take it to the income statement as the interest on debenture for the year. Just before it, we are given the interest paid on debenture. How much was the interest paid? The interest paid was 100. So of this 200, they have already paid 100. So there is a balance of 100. Now, this 100, you take it to the balance sheet as part of the current liability. That's the accrued debenture interest. But in case you're just given the debentures without giving the rate, so the debenture in the trial balance, we assume that was the debenture for the year. Then we have the suspense account, ordinary share capital, share premium retained profits, revaluation reserves, cash at bank, receivables, payables, financial asset at fair value, then we have available for sale. Deferred tax, we have obligation under finance lease, lease rental paid, installment tax paid. Additional information, number one. Number one, you're told that the cost and net realizable value of inventory as at that 1st October 2009 was 16 and 1,500 respectively. The cost and net realizable value of inventory. So that's all about the closing inventory. And remember, we said that how do we recognize under special topics to memorize? We say that number one, that inventory should be recognized based on the ROA of the cost and net realizable value. So therefore, in this case, you take the ROA of the two, and the ROA of the two we have it's 1,500. Good. And then there is something we say that whenever you are given the closing stock and additional information, that means you are not given the value of the cost of sales. So we get cost of sale, opening stock plus purchases minus closing stock. So in our trial balance, how much is the opening stock? You can see there's inventory as at 1st of November 2008 was 1,200. You add the purchases. Purchases we have it's 8 million. Then you raise the closing stock, of which we have it's 1,500. And therefore, how much will be our cost of sales? So the cost of sale will be an amount of 7,700. So you are through with number one. Number two, a depreciation on PPE is to be provided at 800 million and classified under cost of sale. 10 million of this amount related to excess depreciation or revaluation. So number two, you're already given depreciation of PPE is to be provided at 800 million and classified under cost of sale. So you'll take it to the cost of sale. So you don't have to compute depreciation of PPE because you already provided. Number three, intangible assets. So number three, we have intangible assets. Intangible assets are to be revalued to 1,800 million. So we say that how to determine revaluation gain or loss? You compare the carrying amount against the revalued amount. Now let's go to the trial balance. How much was the value of the intangible assets? Intangible asset is the third item in the trial balance. Intangible assets we have is 2,000 minus, below it, there is accumulated amortization as at 1st November 2008. That's at the beginning of the year. the accumulated amortization was 400. So that means, assuming we amortized at the beginning, we revalued at the beginning of the year, the net book value of the carrying amount was 1,600 million. So that was the carrying amount. Now, to determine whether there was a revaluation gain or loss, now you compare the revalued amount, the carrying amount against the revalued amount. We go back to note number 3. Intangible assets are to be revalued to 1,800 million. So the carrying amount is 16, the revalued amount is 18. So that means there is a revaluation gain, an amount of 200. And we see that revaluation changes for PPE, available for sale, and intangible assets should be recognized under other comprehensive income. Good. Then, since we revalued at the beginning of the year, intangible assets, they are amortized. So there is amortization. There are sentences you are told that amortization of 400 million is to be charged and classified under admin expenses. So amortization of 400 to be charged and to be classified under admin expenses. Yeah, remember I said that expenses are classified into 4. It's either cost of sale, admin, distribution, or finance. So for amortization, I've been told that we classify them under admin expenses. And number 4, land is held for capital appreciation and is accounted for at fair value. Now note that land is held for capital appreciation. Therefore, this land is not part of PPE. It's what we call investment property, IAS 40. So number 4, we have investment property or land. Now let's go to the trial balance. In our trial balance, how much is the value of land? How much is the value of land? Yeah, it's the 5th item in the trial balance. Investment property, land. In the trial balance, we have an amount of 500, and it's measured at fair value. Now let's go back to note number 4. We go back to note number 4. Land is held for capital appreciation and is accounted for at fair value. As at that 1st October 2009, now that's at the end of the year, the market value of the land was 550. The market value was 550. So there was a fair value gain because it's measured at fair value on amount of 50. Now the question is, where do you classify this 50? We say that revaluation changes for items measured at fair value is recognized under other incomes. So this one will go to other income because it's an investment property which has been accounted for at fair value. Number 5, then land does not depreciate. Number 5, the suspense account related to the new issue of share by Z Limited. So let's go to the trial balance. How much is the suspense account? Let's go to the trial balance. How much was the suspense account? Now, suspense account we have is 2,000. And you have been told that we go back to number 5. The suspense account related to the new issue of share by Z Limited. So it was through the issue of share. On 1st of July 2009, it issued 12 million share for 150. We issued ordinary share 150 million. No, 12 million shares. The company issued 12 million share each at 150. How much did they fetch? You take 12 million each at 150. That's 12 plus 6. You get 18. But the suspense account was 2,000. From the issue of share, it's 18. So there is a balance of 2. What is this 200? Then you're told that the balance in the suspense account is the investment income. So the balance is the investment income. Good. Now this investment income, you take it to other income. And you see we had investment property. So the income earned was 200. And you take it to other incomes. Now, note this. There is something I mentioned about the issue of share. We see that ordinary share capital are recognized at par value, with the balance recognized to the share premium. Now let's be here. Ordinary share capital, share premium. We were told that the company issued 12 million shares each at 150. 12 million shares each at 150. The ordinary share capital should be recognized at par value. Let's go to the trial balance. We go to the trial balance. At the ordinary share capital, how much is the par value? How much is the par value? The ordinary share capital in bracket shillings 100. Now that shillings 100 is the par value. So ordinary share capital will be recognized at par value, but we issued the shares at 150. So there was a premium of 50 shillings per share. So 50. 12 times 100. So to the ordinary share capital, you'll take 1200. Then to the share premium, 12 times 50, you get 600. And you see, if you add the total, you'll get 1800. You'll go back to this 1800. So ordinary share capital should be recognized at par value, with the balance taken to the share premium. Number 6. Number 6. The financial assets were purchased during the year. Let's go to the trial balance. How much was the financial asset? Now, for the financial asset, there are two. We had at fair value, and we have available for sale. I mean the trial balance. So at fair value, it's 600. Available for sale, it's 1,000. I'm hoping you're on the same page. I've just recorded the opening, the carrying amount. Now let's go back to note number 6. Note number 6. The financial assets were purchased during the year. The financial assets are to be recognized as at that 1st October 2009 as follows. At fair value, we recognize them at 700. Then available for sale, we recognize at 1200. So that means here there is a gain. At fair value, there is a gain of 100. 1,000 to 12, there is a gain of 200. Now, financial asset at fair value, we say that their revaluation changes should go to other incomes. So therefore, this one recognized to other incomes. But revaluation changes for PP and available for sale should be recognized under other comprehensive income. But lastly, we are told that last sentence of number 6, deferred tax of 60 million is to be recognized as a result of revaluation of available for sale. Now, what does it mean? For available for sale, there was a revaluation gain of 200, of which this 200, 60 was charged as deferred tax. You see, deferred tax is tax which arises as a result of taxable temporary difference, such as revaluation gain. So 60 is for deferred tax. So that means the balance of 140 is what you take it to other comprehensive income. In case they never gave you information about what to take to deferred tax, the entire 200 could have been recognized under other comprehensive income. But you are told that of that 200, 60 was charged to deferred tax. So the balance of 140 is what will go to other comprehensive incomes. Number 7. Number 7. Number 7, you are told that current year estimated tax is 500 million. And that's tax expense. Remember I said that the tax expense is made up of two elements. One is the current tax and the changes in deferred tax. And you have been told that current year estimated tax is 500. That's the current tax. The deferred tax liability is to be reduced by, not by, it's to be reduced to 300. It's to be reduced to 300. So let's go to the trial balance. Let's go to the trial balance. Go to the trial balance. In our trial balance, how much is the current, how much was the deferred tax? Deferred tax was 500. I hope you can see that. Deferred tax and the trial balance is 500. Plus, let's be here. There was a revaluation gain on PP on available for sale, of which 60 was charged to deferred tax. So you add 60, that was deferred tax charge for the year. But you're told that at note number 7, the last point, that the deferred tax liability is to be reduced to 300 million. To be reduced to 300. 500 plus 60, you get 560. But you know that at the end, it was reduced to 300. From 560 to 300, there was a reduction by 260. That's the reduction. What did we say about reduction in deferred tax? We see that increase in deferred tax is an expense. Reduction in deferred tax becomes an income, therefore reducing the tax liability. So it's a reduction. So if it's a reduction, you reduce. So they'll only pay 240. Then this 300 is what now will take it to the balance sheet as the deferred tax balance comes down. Yeah, there was a reduction by 260, so they only pay a tax of 240. Number 8. Number 8. Number 8, you are told that interest on finance lease is at the rate of 10% per annum and is payable together with the rentals on that 1st October each year. Now, that 1st October is at the end of the year. So that's what you call lease payable in arrears. So we see that whenever you have a lease, you need to come up with a lease amortization schedule. Lease amortization schedule. And this lease is payable in arrears because you are paying together with the rentals as at that 1st October. Now, remember you see that under IFRS 16, you need to recognize risk as an asset as well as an liability. But in this case, they have already accounted for it because you're not given the fair value, but you're given it in the trial balance. It's something they have been accounting for it. And then we see that you only prepare for 2 years. Period 1 and 2. Then since we are paying in arrears, we see that the format will change. So you'll start with the balance brought down. Then you determine the interest. Then you determine the payment. Then of this payment, you determine the principal. And then you get the balance carried down. So in this case, we don't have to compute the lease liability because number 1, we are not told it was for how many years. And then they have already accounted for it. That's why it's in the trial balance. So how much was the opening balance? Now let's go to the trial balance. Let's go to the trial balance. You go to the trial balance. In our trial balance, we have obligation under finance lease as at 1st November 28. It's 1,000. That's at the beginning of the year. And number 8, you have been told that the interest rate is 10%. So you'll take 10% of 1,000, which is 100. Then, how much is the payment? Now, let's go to the payment. Still in the trial balance, the second last item, we have lease rentals paid. So the payment was 200. We see that the payment comprised both the principal and the interest. If you paid them 200, of which the interest was 100, therefore how much was the principal? So you take 200, you minus the interest to determine the principal, which is 100. Therefore, to get the balance carried down, you take the balance brought down minus the principal, and you'll get 900. Then the balance carried down becomes the opening balance, and 900. Interest is 10%, so it will be 90. 900, this is 90, and then the payment does not change. Payment is 200. You paid 200, of which the interest was 90. So how much was the principal? It's 200 minus 90, you get 110. How much will be the balance carried down? To get the balance carried down, you take the balance brought down, you deduct the principal. 900 minus 110, and you get 790. Good. So what do you take to the income statement? So it's that to the income statement, you take two items. One is the depreciation on the right to use the asset and the interest. In this case, you are not given the lease period. But in note number one, you have been given, in note number two, depreciation on PPE, because we list an item of plant, they have already accounted for it. So that means its depreciation is already included there. Interest, you take for the first year. Yeah, so to the income statement, we see it's first year. That's the year we are operating. And the interest here, it's 100. Then what do we take to the balance sheet? To the balance sheet, we say that you extract from the second year. We have what you take to the non-current liability, and we have what you take it to the current liability. Now, we say that when the risk you are paying in advance and when you are paying in arrears, it will be totally different. If you are paying in arrears, what you take to the non-current liability, you take the balance carried down for the second year. The second year, the balance carried down is 790. Then the current liability, you see that you take the principal. And the principal is 110. I repeat again. To the non-current liability, you take the balance carried down for the second year. Then the principal, you take it to the current liability for the second year. That's when you are paying in arrears. If you are paying in advance, for example, if you are paying in advance, we see that what do you take to the non-current liability, what do you take to the current liability? You will still get from the second year, but non-current liability will take the balance due. And then to the current liability, you take the payments. But when you are paying in arrears, to the non-current liability, you take the balance carried down, and then current liability, you take the principal. So kindly revisit accounting for risks. I've explained and elaborated on that. Good. So I think now we are done with all the additional information required. Published statement of comprehensive income for the year ended that 1st October 2009. Then summarized statement of changes in equity, and then the published statement of financial position. Yeah, and I have provided the solution in your notes, so you can follow on that. So first of all, let me present the income statement. Then for the rest, you can be able to follow from the notes. So it's now, before I present the financial statement, let's compile expenses. For the expenses, we have the cost of sales, we have admin, we have distribution, and we have the finance cost. For the cost of sale, this was the opening balance, 7,700. How much was the admin? Let's go to the admin in the trial balance. Admin we have is 2,600. Then we have distribution. The distribution we have 2,400. Finance cost, you take this, the 10% of 2,000, which is 200. Then you add, for the finance cost, now you can add the interest of 100. And then we adjust. To the cost of sale you add, Number two, I told that depreciation of PPE to be included at the cost of sale, so you add 800. There was amortization of intangible assets, 400 to be included at admin. So to admin, you add 400. I think those are all the expenses. So this one will be an amount of 85, and this one will be 3,000. Good. So then I think we have adjusted everything. So now I want you to go and prepare, because this was the third illustration. Go and prepare the financial statement. Now, once you prepare, first of all, prepare for yourself. Because I have provided everything. PPE, you don't have to work, because in this case, you're already given the PPE. We are not given the breakdown. You're given the entire PPE. So you prepare for yourself, then you mark for yourself, because in your notes, I have provided the solution on how you're supposed to prepare the published financial statement. Then on your notes, I have provided some assignment. So if you get time, you can try those assignments. So, and that marks the end of published financial statement. More questions will be done during the Brock's revision. So you can check on your Brock's revision videos. So thank you for your time.